There's a part of the financial system most Americans never hear about. It's called private credit. In simple terms, private credit funds are investment firms that lend money directly to companies instead of banks doing it. There are firms like Blue Owl, Apollo, Blackstone, Ares. Instead of you putting money into a savings account and the bank lending it out, big investors, pension funds, insurance companies, wealthy individuals give money to these private credit funds, and those funds in turn lend it to companies. Who are they lending to? Usually companies that can't easily borrow from traditional banks. That includes venture-backed startups, tech firms, software companies, and private equity owned businesses. There are a lot of unicorns, high growth companies that aren't profitable yet that rely on this money. For the past decade, it worked beautifully. Interest rates were low, tech was booming, these loans paid high returns. But now software stocks are struggling. Tech valuations are down, growth is slowing, and some analysts estimate that 10 to 15% of private credit borrowers could default if conditions worsen. That's where things start to get uncomfortable. Blue Owl and others are already tightening their lending standards. When lenders pull back, credit gets more expensive and harder to get. And that doesn't just affect startups. Private credit has grown into a $2 trillion market. It funds mid-sized businesses, healthcare groups, and real estate projects. If lending slows, businesses can't refinance debt. They lay off workers, projects get delayed, expansion stops. Then banks begin to get cautious. And suddenly, borrowing for everyone, small businesses, home buyers, even credit cards, becomes more expensive. That's the trickle-down effect. Now here's the part people aren't saying out loud. If private credit faces a wave of defaults, who steps in? These aren't traditional banks with FDIC backing. They're investment vehicles. Many are tied to insurance companies. Some are deeply interconnected with pension funds. The Federal Reserve can stabilize banks, but would it bail out private credit funds? There is no clear answer here, and that's what makes this delicate. Private credit grew fast because it operated in the shadows of traditional banking regulation. It was flexible, profitable, and it filled a gap. But if too many loans sour at once, it could become the next pressure point in the financial system. Think the 2008 housing crisis. The real issue isn't whether a few startups fail. That's baked into the risk. It's whether credit tightens for everyone because of it. And if that happens, the question becomes simple as it pertains to a bubble. Does this stay contained or does it spread into the real economy? Let me know your thoughts.